What if the next global financial crisis doesn't start in the United States, but from the rest of the world running out of US dollars? Right now, something unusual is happening in the global financial system. Countries are selling US treasuries, emerging markets are struggling to refinance debt, and central banks are scrambling to secure dollar liquidity. Most people assume the world has too many dollars, but historically, global crises often happen when there are not enough dollars. And if this trend continues, it could trigger currency crashes, debt defaults, and major market volatility worldwide. In this video, we'll break down what a global dollar shortage actually is, why it has triggered past crises like 2008 and the Asian financial crisis, and why signs of another dollar squeeze may already be appearing. But before we dive in, quick reminder, this video is for information and analysis only, not financial advice. To understand a dollar shortage, we first need to understand something critical. The US dollar is the backbone of the global financial system. Nearly 90% of global foreign exchange transactions involve the US dollar. Around 60% of global central bank reserves are held in dollars. And most importantly, a massive portion of global debt is issued in US dollars, even outside the United States. Countries, corporations, and banks across the world borrow in dollars because dollar interest rates are often lower. Global investors trust the currency, and international trade is mostly priced in dollars. But this creates a dangerous dependency, because if dollars suddenly become scarce, the entire global system begins to strain. A global dollar shortage doesn't mean dollars disappear. Instead, it means demand for dollars rises faster than supply. This usually happens during periods of rising US interest rates, global financial stress, or tightening liquidity conditions. Here's the mechanism. When the Federal Reserve raises interest rates, US assets become more attractive. Investors around the world move capital into US Treasury bonds and dollar assets. This pulls dollars out of emerging markets and global financial systems. At the same time, countries and corporations that borrowed in dollars must still repay their dollar debts. So suddenly everyone needs dollars at the same time. And that's when stress begins. This dynamic has triggered major financial crises before. One of the most famous examples was the Asian financial crisis of 1997. Many Asian countries had borrowed heavily in US dollars. When global liquidity tightened and currencies weakened, their debt suddenly became much more expensive. Currencies collapsed, markets crashed, and several economies required international bailouts. A similar pattern appeared during the 2008 global financial crisis. European banks had massive dollar liabilities, but when credit markets froze, they struggled to access dollars. The situation became so severe that the Federal Reserve had to open emergency dollar swap lines with foreign central banks to stabilize the system. In other words, the Fed effectively became the global lender of last resort for dollars. Now fast forward to today, several warning signs are appearing again. First, global interest rates remain elevated, making dollar funding more expensive. Second, many emerging markets accumulated large amounts of dollar debt over the past decade. And third, global investors are once again moving capital into US assets, especially treasury bonds. In fact, some countries have been selling US treasuries to raise dollar liquidity, and that's a signal that dollar funding conditions may be tightening. Meanwhile, global trade growth has slowed and several economies are facing currency pressure against the dollar. If the dollar continues to strengthen, countries with large dollar debts could face significant stress. A global dollar shortage doesn't just affect governments. It impacts stocks, commodities, and crypto markets as well. Historically, when the dollar strengthens sharply, emerging market stocks often fall. Commodity prices can become volatile. Global liquidity always tightens. For investors, this environment tends to favor safe assets like US treasuries and the dollar itself, but it also increases the risk of financial instability in weaker economies. And in extreme cases, it can trigger debt crises. If dollar stress becomes severe enough, the Federal Reserve has tools to stabilize the system. One of the most important tools is central bank swap lines. These allow foreign central banks to temporarily borrow dollars from the Fed and distribute them to banks within their own financial systems. During the 2008 crisis and the pandemic shock in 2020, these swap lines played a crucial role in preventing global financial panic. But the key question is this: will the Fed step in again if another global dollar squeeze begins? Or will markets be forced to adjust first? The global financial system depends heavily on the US dollar. That dominance creates stability during normal times, but during periods of financial stress, it can also create dangerous vulnerabilities. And right now, several indicators suggest that global demand for dollars may be rising again. Whether this develops into a full dollar squeeze remains to be seen, but if history is any guide, the world tends to notice these risks only after the crisis has already begun. If you found this breakdown helpful, Consider subscribing to Finance Buzz with Harold for more deep dives into global finance, geopolitics, and the forces shaping the markets. And let me know in the comments, do you think the global financial system is too dependent on the US dollar?